The title of the webinar is Holding Jurisdictions for Investments into China. My name is Christina Kohler, and I'm not only the daughter of our founder, Mr. Klaus Kohler, but I'm also a director of the company. I have worked in the Chinese legal and accounting industry since 2003 when I joined Clayco Group as its China director. I advise and represent Western clients, mainly from Europe, North and South America, and Australia, with their business interests in China. I have worked on transactions which have included foreign direct investment, including corporate structuring and restructuring, company liquidations, M&A deals, and I frequently advised on tax, accounting, and trade-related matters. Today's webinar is going to be focusing on holding jurisdictions for investments into China. With the anticipation of sustained growth in China, the influx of investment into China likely will continue. Although investment can be made in a number of ways, this webinar looks specifically at the use of a holding company structure as a potentially tax-efficient method of inbound investment into China. By interposing an overseas holding company to hold a Chinese subsidiary, a foreign company can obtain business and tax benefits, the latter including possible lower withholding tax rates and access to beneficial tax treaties. Included in the webinar is a comparison of the tax rules in 8 jurisdictions often used to structure investment into China, and an examination of recent steps taken by the Chinese tax authorities to improve their administration of taxes and ensure that non-residents comply with their tax obligations in China. One of the most important issues a potential investor needs to consider is the tax implications of an investment. For instance, 2 entities may be earning the same level of profits on their investments in China, but the difference between their after-tax returns can be substantial if one entity is subject to a dividend withholding tax of 10% versus only 5%. Now, is there a generic tax-efficient holding structure for investment into China? The answer can be yes and no. The answer can be no because the design of any holding structure depends on various factors. The rate of withholding tax on dividends, how dividends will be taxed in the country of residence of the investing entity, the tax position of the investee company, the appropriate gearing level, the industry involved, and ultimately the form of the investment. On the other hand, the answer can also be yes if the focus is on the location of the investment holding company and a thorough comparison of the applicable taxes in the various jurisdictions are undertaken. Of course, the local tax implications in the country of the overseas holding company must also be considered. At the level of the Chinese subsidiary, it will be necessary to consider the Chinese withholding tax on dividends and capital gains. At the holding company level, the following will have to be taken into account: taxes on dividends and capital gains, withholding tax when the holding company pays dividends to its shareholders, the effective corporate tax rate, tax on distribution proceeds when the holding company is liquidated, stamp duty that may be applicable when the shares of the holding company are transferred, and the tax treaty network of the jurisdiction in which the holding company is located. At the China company level, the following will need to be taken into account. China's substance requirements under both its domestic law and its tax treaties must be considered. China has stringent requirements that a non-resident must meet to qualify for benefits under its tax treaties. And recent guidance issued by the State Administration of Taxation emphasizes that shelf or conduit companies may not be used merely for the purpose of enjoying treaty benefits. The State Administration of Taxation has issued several circulars that contain detailed rules on the application and approval procedures, as well as documentation requirements that apply to non-residents claiming benefits under the China tax treaties. For an example, a major criterion of eligibility for the preferential tax rate on dividends under China's treaties is that the non-resident must be the beneficial owner of the income. According to the State Administration of Taxation, the presence of the following factors indicates that a non-resident may not qualify as the beneficial owner. The first, the non-resident transfers most, meaning more than 60% of its income within 12 months to residents of a third country. The non-resident has no or only minimal business activities other than the holding of the property and or rights from which the income is derived. The non-resident's business in terms of assets, scale of operations, and personnel is not commensurate with its income. The non-resident has no or nearly no rights of control or disposal over the owned assets or rights generating the income. And finally, the country of the non-resident either imposes no tax or imposes tax at an extremely low effective rate. The State Administration of Taxation will scrutinize both commercial and economic substance. Both the non-resident and the withholding tax agent in China are required to meet rigorous disclosure requirements. For example, identification of any direct or indirect shareholding in a Chinese company, a description of the major business operations and projects, information regarding the number of employees, details of related party transactions, and so on, to demonstrate that the recipient is not disqualified by any of the previously mentioned factors, and basically to support a beneficial ownership claim with a view toward obtaining reduced withholding tax rates under a tax treaty, for example, on dividends, interests, royalties, and capital gains. It is not sufficient for the non-resident simply to produce a tax residence certificate issued by the non-resident state of residence. What this basically means is that it's not sufficient to produce a tax certificate issued from the Hong Kong Tax Bureau, as an example, to provide to the Chinese authorities. You do need to provide substantial documentation. The reduced tax rates under a tax treaty are not available until the approval of the in-charge tax bureau is granted. Generally, these items that I've listed are actually more geared towards multinational companies or very large companies that have made considerable amounts of profit in China and want to repatriate this profit back to their shareholding entity. The tax bureaus will scrutinize the transfer of these profits to see whether the beneficial tax rate can be utilized. Foreign investors may have a choice of jurisdictions in which to locate a holding company as long as the substance requirements can be met. This section looks at 8 jurisdictions commonly used as holding company locations to determine their suitability for investment into China. I've looked at Barbados, Belgium, Hong Kong, Ireland, Luxembourg, Mauritius, the Netherlands, and Singapore. A comparison of the various relevant tax rates in these jurisdictions are shown in the table, and I'm going to tell you a little bit about a comparison of these tax implications based from the China perspective. So the first point I'm going to emphasize on is dividends. Under Chinese domestic law, a 10% tax is withheld on dividends paid to a non-resident. Most of China's tax treaties, with the exception of the treaties with Belgium and the Netherlands, reduce the withholding tax rate to 5% if the relevant shareholding and other requirements are met. And again, I'm focusing on these 8 jurisdictions and only these 8. Capital gains. According to the enterprise income tax law, a 10% withholding tax is levied on capital gains derived by a non-resident enterprise without a permanent establishment in China from the direct transfer of an equity interest in a Chinese resident enterprise. Then there are direct transfers of shares. In the past, Barbados and Mauritius were commonly used as holding company jurisdictions to structure investment into China because China's tax treaties with both countries included an exemption from the 10% Chinese withholding tax on capital gains arising from the disposal of shares in a Chinese company, regardless of the percentage of the shareholders' participation. So regardless of the amount of shares a shareholder was holding, there would be only 10% withholding tax on disposing the shares. Following changes to the China-Mauritius Treaty and the Barbados-China Treaty in 2006 and 2010, capital gains are no longer exempt if the recipient of the gains holds directly or indirectly more than 25% of the Chinese company. Chinese treaties with most of the other jurisdictions do not allow China to impose a tax on capital gains arising on the transfer of shareholding of less than 25% in a Chinese company, except in the case of the Netherlands, which allows tax to be levied regardless of the percentage of shareholding. Under the tax treaty with Ireland, China does not tax capital gains even when the relevant shareholding is more than 25%. As mentioned, maintaining substance is paramount. The State Administration of Taxation has the authority to invoke the Chinese General Anti-Avoidance Provision for transactions whose dominant objective is the avoidance of tax. There have been instances in the past when a company has failed to attain the required level of substance, and the State Administration of Taxation has accordingly denied treaty benefits. I'll give you a general example. In the reference of a Hong Kong company that has disposed of 20% shareholding of a Chinese company, was held to not have met the below 25% shareholding requirement for purposes of capital gains tax exemption under the China-Hong Kong Agreement because the Hong Kong company owned another 18% shareholding of the same Chinese company through another Hong Kong group company. What this means is that there was a Hong Kong group who had two companies owning shares in the same Chinese entity. As such, the State Administration of Taxation was looking through the links to find the ultimate group holding entity to see that actually this group holding was owning 38% of the shares through two other Hong Kong companies. And as such, they were not allowed to achieve the treaty benefits. A strategy that has been employed in the past to avoid capital gains taxation in China involves using an overseas holding company to invest in China and then exiting the investment by transferring the overseas holding company. The jurisdiction of the holding company in these structures typically either taxes capital gains at a low rate or does not tax them at all, and has concluded a tax treaty with China that provides beneficial withholding tax rates. The State Administration of Taxation has challenged the treaty exemption of gains derived from these structures on the grounds of lack of substance. For example, the Chinese tax authorities held that capital gains arising from the transfer of shares of a Singaporean company that held an equity interest in a Chinese company in Chongqing were capital gains arising from the disposal of the underlying Chinese company. As a result, the transaction was treated as a direct sale of the Chinese company by the parent of the Singaporean holding, and hence was subject to the full 10% tax on capital gains. The State Administration of Taxation took the position that the Singaporean company lacked economic substance because it did not engage in any business activities other than holding the shares of the Chinese company. They had only a minimal amount of capital and no employees, and was used merely for the purpose of avoiding capital gains tax. which in the end they were not even successful in claiming. Some practitioners have argued that most holding companies would not have substance because they normally do not have a significant amount of capital and do not carry on other business activities. In response, the State Administration of Taxation has agreed to centralize the application of the general anti-avoidance provision and to discourage transactions with the dominant objective of avoiding China's capital gains tax through an indirect transfer of shares. The State Administration of Taxation issued 2 circulars. In these circulars, it states that if a foreign investor indirectly disposes of the shares of a Chinese entity, the State Administration of Taxation, using the substance over form principle, can disregard the existence of the intermediary holding company if it lacks a business purpose and was established for the purpose of avoiding tax. In this case, the foreign investor would be subject to Chinese withholding tax on capital gains derived from the transfer. So ultimately, you need to look at the chain of entities that you have and investigate whether there's substance lying in the intermediary holding company to show to the Chinese tax authorities. Furthermore, Circular 698 imposes a documentation requirement on the non-resident investor if some conditions are met. Specifically, the non-resident investor must submit all transfer agreements and other relevant documentation regarding the equity transfer and the relationship between the non-resident and the offshore holding company to the local tax authorities. And basically at that point, the State Administration of Taxation will finally impose whether there is a capital gains tax or not and at what rate. When group companies with indirect Chinese equity interests are located in some jurisdictions, it may be possible for a multinational group undertaking a genuine commercial M&A to transfer its investment in China among those group companies without breaching any of the previously mentioned conditions, and thus making it possible for the multinational group to avoid falling within the scope of the reporting obligations. As I mentioned, there are numerous ways of actually structuring your entities. You cannot just look at where the holding company will be placed. You also have to see where those beneficial owners of that holding company are also based in order to properly define what tax implications will be made. I want to focus now on whether these jurisdictions, these 8 jurisdictions that I have mentioned previously, whether they are suitable or not. Now, taking into account the minimum tax rate requirements, it would appear that Barbados and Mauritius might not be the best choices for locating a holding company because their effective corporate tax rates are both lower than 12.5%. It's 1 to 2.5% and 3% respectively. So what this basically means is that because they are in extremely low tax rate jurisdictions, the Chinese government will be emphasizing and will be scrutinizing the holding companies, particularly because of these low tax rates. Regarding the second condition, Hong Kong generally does not tax offshore income, and Singapore does not generally tax foreign source dividends, foreign branch profits, or foreign source service income. As a result, Hong Kong and Singapore also may not be the best holding locations for purposes of indirect transfer of Chinese investments. So again, it's important to look long-term at what your strategy is when entering the China market. Initially, when you're setting up the entity in China, a holding jurisdiction in Hong Kong and Singapore can be extremely advantageous. If, however, you are looking to eventually sell the shares of the Chinese entity, then Hong Kong and Singapore might not be beneficial. Transaction cost considerations may also make Hong Kong, Singapore, and Ireland unattractive because all 3 jurisdictions would impose stamp duty on the transfer of shares. Turning to other factors, it seems there could be tax leakage if the holding company is located in Barbados, Belgium, Ireland, or Mauritius, because these jurisdictions impose a tax on dividends received. So again, you need to consider this. once you repatriate dividends from the holding entity to your home jurisdiction, will there be tax imposed? Although neither Hong Kong nor Singapore taxes capital gains, it is not uncommon for disputes with tax authorities to arise over what constitutes a capital gain as opposed to a revenue gain. And this occurs during the audit process as well as the tax exemption claim in Hong Kong and in Singapore. So this also needs to be taken into consideration. In the case of dividend distributions, some countries, such as Belgium and Ireland, impose withholding tax when dividends are distributed to non-treaty recipients. And lastly, the tax treaty network of the proposed holding company jurisdiction is also a factor that cannot be ignored. In this respect, Belgium and the Netherlands have the largest number of treaties. Although both Luxembourg and Hong Kong are negotiating new treaties or tax arrangements to incorporate the OECD's Exchange of Information article. What this basically means is that Hong Kong previously did not have an article on the exchange of information. In fact, if any tax officer worldwide would contact Hong Kong for information on a company, Hong Kong would not provide that information. Since a year and a half, they've added this exchange of information article whereby any tax authority anywhere in the world can contact Hong Kong in order to obtain information. This has freed up Hong Kong in obtaining tax treaties with other countries because of this exchange of information article. As such, Hong Kong right now is at a level of having agreed on 24 tax treaties, which I believe 15 are waiting to be ratified. And there are more discussions in place. Just last week, we received a notification that Italy and Hong Kong are in negotiations for a comprehensive double taxation agreement, and it could be that this arises within the next year. Here, I'm focusing on Hong Kong as one example, one specific example in regards to having it as an inbound investment vehicle. Because of Hong Kong's close proximity to China and the fact that it does not levy withholding tax on dividends or capital gains, it is most common for a Hong Kong company to be used as the direct holding company for many Chinese investments. The advantages of a Hong Kong holding company from a tax perspective are as follows. The mainland China and Hong Kong have concluded a double tax arrangement that provides for one of the lowest withholding tax rates on dividends, royalties, and interest in the Asia-Pacific region. Hong Kong does not tax dividend income or capital gains. Hong Kong does not tax offshore income. And finally, Hong Kong does not impose withholding tax on dividends and interest payments. Although Hong Kong now has 22 double tax arrangements in effect and has 24 double tax arrangements in effect and more to come, from a Hong Kong tax perspective, it is not crucial that there be an agreement between Hong Kong and the country of residence of the shareholders of the Hong Kong company, because Hong Kong does not impose withholding tax on dividends and capital gains. What is important is whether the dividend income and or capital gain will be taxable in the country of the recipient. Of the jurisdictions under review, most tax dividends and capital gains are under given circumstances are required to pay taxes. A company holding shares in a Hong Kong company generally will enjoy more protection if it is located in a treaty country. For example, Luxembourg's participation exemption system generally exempts Hong Kong dividend income and capital gains. However, in Belgium, there could be tax leakage because Belgium generally taxes dividend income. The tax rules of the jurisdictions where the investments are located also should be taken into account. Some countries, such as Germany and the United Kingdom, have controlled foreign corporation rules that can effectively discourage indirect investment into some foreign jurisdictions. And I just want to make my conclusion. In conclusion, for foreign direct investment into China, The most important factor is that the investor has sufficient commercial and economic substance to withstand any challenge by the Chinese tax authorities. A holding company making such an investment should not simply be a shelf or conduit company if it is to enjoy benefits under China's tax treaties. If the requisite level of substance is present, a holding company can be located efficiently in Luxembourg, Hong Kong, or Singapore. If Ireland, which provides preferential exemptions for capital gains under its treaty with China, is used, care must be taken to ensure that no tax leakage will be suffered because Ireland generally taxes dividend income. The Netherlands and Belgium may not be efficient locations for a holding company because China imposes a 10% withholding tax on dividends paid to residents of those jurisdictions, rather than the 5% that applies in the case of dividend recipients resident in the other jurisdictions under review. So for example, in Hong Kong, Barbados, Mauritius, Singapore. For indirect investment into China, multinational groups with genuine merger and acquisition transactions involving the disposal of interest in a Chinese company could consider setting up a structure with at least 2 levels of holding companies for Chinese inbound investment to avoid the onerous reporting requirements. Naturally, if you're not a multinational, you're a small, medium-sized company, then obviously there are other tactics and other business models that can be created. Given the changing international tax environment as well as the ever-increasing Chinese regulatory requirements, it is no longer a simple task to set up a tax-efficient holding structure for Chinese investment. Thus, taxpayers are advised to seek professional advice before the implementation of any structure, both from their own home country as well as the holding company jurisdiction and finally in China. You need to make an investigation on the full link of your entities. I hope you enjoyed today's webinar. Should you have any questions related to holding jurisdictions, please do not hesitate to contact us. We can provide you with information on Hong Kong, Singapore, and other offshore jurisdictions such as British Virgin Islands, Cayman Islands, Samoa, Seychelles, and Anguilla, which were not mentioned today. In order to show substance in these holding entities, Clayco Group can also offer concrete, affordable solutions to companies who do not want to take the risk in encountering problems with such structures. Again, please contact us if you would like further information. My details are listed here, and I can be reached by email at christina.kohler@clayco.com. In addition, I would like to inform you that should you or your colleagues wish to join this webinar again, you will have the chance. I am broadcasting this same webinar on June 13th and June 20th. The details of the broadcasts are listed on our website. If you are new to our company and or our website, I would like to let you know that I am co-author of our monthly magazine, ChinaInvest.biz, which provides insight into investment, tax, and operational issues for foreign companies entering and expanding throughout China. If you would like to, you can subscribe free of charge to our monthly magazine as well as our webinar information by going to www.chinainvest.biz and simply adding your email address. You will then receive our mailings in regards to our magazine, our webinars, and our case studies. In addition, on our website, you can find more information about our upcoming speaking engagements and roadshows in case you would like to participate in these. I hope you enjoyed today's webinar. I wish you all a pleasant day or evening, depending on where you're located in the world, and I look forward that you join us again soon. Thank you and good evening.